The second topic in this chapter is error corrections. Here we're talking about transactions that were either recorded incorrectly or potentially not recorded at all. It's a separate topic from accounting changes and is pulled into this chapter because one of the accounting methods that we'll use with accounting changes will also be used to handle error corrections. Some examples of things that would be picked up as an error correction would be when the company misuses facts. So, for example, estimated life was 10 years, but inappropriately management used 20 years. It was simply a misapplication of the correct facts. Misapplication of the correct accounting principle. Use of an incorrect principle, or just simple mathematical or software mistakes that result in errors entering into the accounting records are all examples of errors that would need to be corrected. The two accounting methods that we'll use with accounting changes and error correction are called the retrospective and the prospective approaches. Retrospective refers to looking back, and prospective refers to a go forward or a future basis. This graphic illustrates that with the retrospective approach, the current year and the prior years are affected. In contrast, the prospective approach involves the current year and future years. The retrospective approach refers to looking back. So what this approach is going to result in is restating previously issued financial statements so that the revised financial statements are now consistent with a new principle, the new entities included in the consolidated financial group, or with correcting an error. Notice that this approach is going to be used with every category except a change in estimate. So what happens with the retrospective approach is we're going to adjust the balance sheet to where it would have been had the new method or the error not been made, etc. So the effect of the retrospective approach is to revise previously issued financial statements, and we'll do that by making an entry to adjust the beginning balance sheet accounts. And we'll have an example of both the retrospective and the prospective approach. The prospective approach focuses on using the new information in the current year and in future years. So there are no changes made to accounts or financial statements. There are no journal entries made. The prospective says, let's get it right in the current period and carry on. Again, this method is typically used with changes in estimates, and our assumption there is that management used the best information available originally and something has changed. So to reflect the fact that something has changed, we'll record a different amount of, let's say, depreciation in the current period than we otherwise would have, but things were recorded appropriately in the past, so there's no reason to go back and change account balances. The entry that our contractor would make to record the change to percentage of completion accounting is shown on this slide. Notice that construction in process is debited for $220,000, which is the difference on the previously issued financial statements between the accounting method they were using and the one that they're switching to. We offset that with credits to deferred income taxes, because the assumption is that the contractor would have to record deferred taxes on that additional gross profit, and the net amount, $132,000, goes to retained earnings. In essence, we're saying that the contractor's net income over the years affected would be increased by $132,000. Notice that all of these accounts are balance sheet accounts. What this entry does is to move the beginning balance sheet to the balances that would have been shown had the contractor been using the new method all along. The current year financial statements, the current year income statement, will be based on the new method, and any income statements that are shown for comparison purposes would have their gross profit amounts adjusted also. Now let's look at an example of using the prospective approach. Remember that here we begin using the new information in the current year and the future years. So for this example, we will assume that in year one, the company purchased equipment that had a historical cost of $140,000. At that point in time, management estimated that the equipment would have an 8-year life and no salvage value. So some time passes, it's now year 4, and management now changes their estimate of life. So based on their experience, they're reducing the estimated life from 8 to 5 years in total. So what they're saying is that they'll be able to use this asset in year 4 and 1 more year in year 5. With the prospective method, the company is going to allocate the remaining book value over the remaining life. With the prospective approach, in the year that management receives the new information or based on their experience changes their estimate, they re-estimate the amount of depreciation to record on the asset. So management uses the original historical cost. They subtract from that the annual depreciation that they've taken in the prior 3 years, and that determines that the remaining book value is $87,500. This is the amount that will be allocated to depreciation expense over the remaining life of the asset. That's now been reduced to 2 years, the current year and next year, and revised depreciation is now $43,750. A considerably higher amount because management has shortened the estimated life of this asset. This is the amount of depreciation that the company will record on this asset as depreciation expense in the current year. They will not change any beginning balances on the balance sheet or change anything on the previously issued financial statements. This graphic summarizes what we've discussed related to the 3 types of accounting changes and then our category of error corrections, showing the appropriate method, whether or not you restate prior years, any cumulative effect on previously issued financial statements, and whether or not you make a journal entry. Notice that for this, something that we have not previously discussed is that here the changes to accounting principles are broken into 2 categories. Most will be accounted for as we've previously discussed. Some that are considered exceptions to the general rule are carved out and treated differently. For this group, we'll use the prospective approach. The reason for this are changes where the company cannot determine the effects, or making the change retroactively would require making a lot of assumptions about management's intent or making significant estimates. An example of where this would be typically the case would be if a company changes to LIFO. It's often very difficult to go back and create those LIFO layers in the pricing information needed if it wasn't captured at the time. The following slides show our comparison of GAAP to IFRS. In the area of accounting changes, the 2 methods are extremely similar. Notice that IFRS is consistent with GAAP for considering a change in depreciation methods to be a change in estimate. This was an early impact of IFRS on GAAP, and when accounting changes were modified, the FASB based their new proposal on IFRS, which had treated changes in depreciation methods as changes in estimates.